Hello class, this is Instructor Zaire, and I just wanted to give you some insight on Chapter 9. Chapter 9 we learn about tools that are used in the capital budgeting process to determine if a company wants to undergo spending for a new project or a new piece of equipment or possibly a new building or a new business line. And so we're going to focus on learning these tools. All of the different tools are presented in the chapter. Payback is a pretty quick and simplistic way to evaluate a project, but it doesn't take into account time value of money, so it has drawbacks. Discounted payback does take into account the time value of money. However, the payback period, one disadvantage of either of these is the payback period is set arbitrarily by the person making the decision. So a company could miss out on some good opportunities if they only use the payback model. Net present value is probably the best tool, and your homework, a couple of the problems focus on that, so make sure you learn and understand net present value. And profitability index is also a good tool to learn. We're not going to focus so much on average accounting return. We are going to spend some time on internal rate of return. One of your homework problems deals with that. Modified internal rate of return, we won't spend as much time on that. So capital budgeting and the tools that we just talked about are used to make decisions, whether to replace a piece of equipment, whether to expand a product or a service, ways to reduce costs, and also should we introduce a new product or service into the market. As you begin reading Chapter 9, you'll probably see some similarities between the Chapter 9 and the prior two chapters that we covered relating to stocks and bonds. All three, we look at future dollars that must be considered, and in all three, we have to convert future dollars into present value terms. With the capital budgeting decision, we also make an accept or reject decision based on our findings when we convert the cash flows into present value form. You'll remember from the prior chapters that a bond has coupon payments or interest payments and a lump sum due at maturity. A stock has dividend payments forever, and projects have cash flows that end. Coupon payments are fixed based on a coupon rate or a fixed rate of interest. Stock dividends can change from time to time. Project cash flows are typically different each year, so that's kind of similar to a common stock cash flow scenario. Some differences with bonds and stocks: our goal is to determine the value today. Our goal with projects is to determine if we will exceed our cost with the cash flows identified. Our overall goal in using these cash flow tools is to determine if we should accept or reject the project. Let's take a look at payback period. It is a quick and easy way to evaluate a project, and basically we're looking at how long it takes for us to recoup our initial cost, and we look at estimated future cash flows from a project, and then we determine at what point those cash flows would cover our initial cost. So let's say we've got a project that initial cost is $165,000, so you'll see that that's noted as a negative because that is money coming out of our organization. And then we project, based on our analysis, that the current flat cash flows from that project, $63,120 in year 1, $70,800 year 2, $91,080 in year 3. Net income, if we were going to use that in another model, this would be our net income after expenses. And we estimate that this piece of equipment will have an average book value of $72,000. For our example here, let's just say that we have determined that we want all of our projects, we want to recoup our costs within 3 years of time of acquisition. So if we take our initial cost of $165,000 and subtract the positive cash flow in year 1, we still have $101,880 to recoup. Then in year 2, we take the remaining amount of cost to recoup minus our cash flow in year 2. That leaves us $31,080 to recoup. Then during year 3, we have cash flow of $91,080. So during the year, we are going to recoup our costs sometime between year 2 and the end of year 3. So we passed that 3-year mark because we're going to recoup our cost between year 2 and year 3. So this would be a project, if we use the payback model, that we would accept. With the discounted payback model, we would actually discount each of the cash flows to take into account the time value of money. Now the 165 goes out on day 1, so it does not have any time value. However, cash flow 1 is received after year 1, cash flow 2 after year 2, cash flow 3 after year 3. Required rate of return is 12%. Again, that was set by the company. So what we would do is we would find the present value of each of these cash flows based on a 12% rate of return. And this would be with 1 year, this one would be with 2 years, and this one would be with 3 years. So if we need to compute present values, if it's not given to us in a problem, what we could do is we could use Excel, and we could use our financial formulas. We want to use present value, and then we would just plug in the information. Our rate was 12%. For the first cash flow, we had 1 year. The future value was $63,120. So that means that the present value of that cash flow would be $56,357. Year 2, we would use 70,800, but our number of periods would be 2. So let's do that in Excel. So our rate was 12, number of periods is 2, and our future value is 70,800. So that means our present value, 56,441. And then lastly, year 3, 91,080 for 3 years. 12%, 3 years, 91,80 gives us 64,828. So now that we've computed all the discounted cash flows, taking into account the time value of money, we would go through the same exercise where we take our initial investment, subtract out the first year's discounted cash flow. That leaves us 108,643 to recoup. Year 2, take out the discounted cash flow for year 2. That gives us 52,202 to recoup. And then year 3, we would take out that remaining discounted cash flow. Again, we recoup our initial investment sometime between year 2 and 3 based on the discounted payback. So using this model, we would accept the project because it still meets our 3-year threshold in recouping our cost. Net present value is probably the most standard model that is used in evaluating projects. And basically what it is, we're looking at the difference between the market value of a project and its cost. Market value is basically the estimate of its future cash flows. We do need to establish a required rate of return for our projects based on the risk level of the project. That is determined internally by financial managers. And then we find the present value of each of the cash flows, subtract out the initial investment, and if our NPV, net present value, is positive number, we would go ahead with the project. So using the same scenario that we had before, a project that costs $165,000 that will generate positive cash flows in 3 different years, we would compute the present value of each of those cash flows, and we could do that in Excel. Then we total those, and so this project has positive cash flows, or present value of cash flows is $177,627. Then we subtract our initial investment, and that gives us $12,627, a positive number. So if we were using the net present value method, this would say we would do this project because it generates positive cash flow for our business. Another way we could do this problem is, rather than computing present value of cash flows for each year, Excel has a net present value financial function. So if we click on financial functions and then go down to NPV, we can insert the interest rate and then the cash flows, and click OK, and it gives us the net present value of the operating cash flows. Then we would subtract out our initial investment, and then we would get our same net present value of $12,627, a positive value after subtracting our initial investment, so we would do the project. Profitability index, we use that when we have several different projects that may have positive net present values, but maybe we can only choose one of the projects because of limited capital. Profitability index helps us determine which one we want to choose. And the computation for profitability index is the present value of the inflows divided by the present value of the outflows. So for example, our prior example had present value of inflows of $177,627 divided by the present value of the outflow, which was the initial cost, gives us a profitability index of 1.07. So a profitability index of 1.076 would imply that for every dollar that we spend in investment, we would create an additional 7.65 cents in value. So a PI greater than 1 means the firm is increasing its value. Now in this case we only had one project we were looking at, but let's say that we had several projects all with positive NPVs. We would compare the profitability index, and if we could only choose one project, we would choose the one with the highest PI. Lastly, we want to look at internal rate of return, which basically discounts all the cash flows to present value, and rather than looking at a positive net present value, we establish an internal rate of return called a hurdle rate, that we want our projects to generate a rate of return above that particular hurdle rate. So Excel also has an internal rate of return function in the financial functions, and one of the differences when using IRR is you would include your initial investment in the cash flows. So you would in this case have in year 0 a negative outflow of cash of $165,000. So if we click on financial formulas and then IRR, internal rate of return, the values that we want are all of these cash flows, positive and negative. And then if we click on OK, it computes our internal rate of return of 16.13, which in this case is higher than our required rate of 12%. So if we were just using internal rate of return, because our cash flows give us a 16.13%, which exceeds our hurdle rate of 12, we would do this project. So I hope this little video and examples in Excel will help you with the assignment for Chapter 9. And if you have any questions, feel free to ask your classmates or ask me, and I'll be glad to help you. Thank you.